Hey investors, and welcome back to the channel. Today, we are diving deep into a fascinating, yet complex, real estate investment trust, CapitaLand China Trust, or CLCT. If you're looking for exposure to China's growth story, CLCT might be on your radar. But is it a good investment right now? Let's break it down. If you haven't already subscribed to our channel, please subscribe to our channel. Your support truly makes a difference, enabling us to produce more stock and fundamental analysis content. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. First, what exactly is CLCT? It's Singapore's largest China-focused real estate investment trust. Managed by CapitaLand China Trust Management Limited, a subsidiary of CapitaLand Investment Limited, CLCT's vision is to be the premier China-focused REIT, offering resilient distributions and sustainable returns. They position themselves as a proxy for investors seeking exposure to China's vast domestic growth opportunities. Their portfolio is strategically diversified across 18 properties in 12 key Chinese cities, including retail malls, business parks, and logistics facilities. As of early 2025, retail assets make up the largest share of their gross rental income, at 71.4%. Now, let's talk about their recent performance. Fiscal year 2024 and the first quarter of 2025 indicate a challenging operating environment. CLCT reported a 5.8% year-on-year decline in net property income for FY 2024, reaching 1,219.1 million renminbi. Distribution per unit plunged by a significant 16.2% year-on-year to 5.65 cents in FY 2024. This decline was largely due to asset divestments like CapitaMall Shuangjing and CapitaMall Qibao. A weaker renminbi against the Singapore dollar also had a significant adverse impact on distributable income. And there's been softness in the business park and logistics segments. In 1Q 2025, overall portfolio gross revenue declined by 6.1% year-on-year, and NPI by 6.6% year-on-year. However, it's not all negative. CLCT's retail portfolio has shown resilience, especially assets that underwent enhancement initiatives. Retail occupancy remained robust at 97.7% in 1Q 2025. Shopper traffic even grew by 2.4% year-on-year, and retail rental reversions were positive at plus 0.5% in 1Q 2025, significantly boosted by supermarket upgrading initiatives. But their business parks continue to struggle, with occupancy dropping to 83.7% in 1Q 2025 due to factors like tenant pre-terminations. So, how is management responding? They're being very proactive with strategic initiatives, capital management and RMB debt. CLCT is making a proactive shift towards increasing RMB-denominated debt, aiming for approximately 50% of its total loan book by the end of 2025, up from 35% in 2024. This acts as a natural hedge against the weaker RMB and leverages lower RMB interest rates, aiming to stabilize DPU. China onshore REIT participation. This is big news. On April 17, 2025, CapitaLand Investment announced its application to launch its inaugural onshore REIT in China, named CapitaLand Commercial C-REIT, CLCR. CLCT is participating by divesting CapitaMall Yuhuating to the new C-REIT. CLCT also intends to subscribe for 5% of CLCR's IPO units. This strategy aims to unlock asset value, access China's vast domestic capital markets, and provide a new channel for capital recycling. Asset enhancement initiatives. CLCT has been actively reconfiguring underperforming spaces. 3 malls enhanced in 2023 showed strong results, with a 13.7% year-on-year NPI growth and a blended return on investment, ROI, of approximately 14%, significantly exceeding the cost of funds. This shows their capability to adapt to changing consumer preferences. Long-term vision. CLCT's CEO, Jerry Chan, maintains an optimistic long-term outlook on China's market, grounded in the resilience of its domestic market. CLCT is even exploring new segments like data centers, aligning with China's AI and technology ambitions. It's crucial to understand the broader context. The Chinese real estate market faces significant headwinds, subdued domestic sentiment. While Asia-Pacific sentiment shows improvement for REITs, investment sentiment among domestic Chinese investors remains subdued due to the sluggish economy and geopolitical pressures. Oversupply in office sector. The office market is struggling with high and rising vacancy rates, projected to reach 25.2% in first-tier cities and 34.8% in second-tier cities by end 2025. This directly explains CLCT's challenges in its business parks. Retail sector challenges, deflationary pressures, weak consumer confidence, and intense competition are prevalent. Logistics sector difficulties. This sector also faces a tough environment due to a large influx of supply. While CLCT's logistics parks have maintained notably high occupancy rates, 95.7% in 1Q 2025, well above the market average of 78%, they still experienced a significant rental reversion of -24.5% in FY 2024. Now, let's look at CLCT's investment profile, focusing on its valuation, dividend characteristics, and growth prospects. Valuation. Analyst consensus target prices suggest a potential upside. Simply Wall ST, based on analysis from 3 analysts, indicates CLCT is 16.1% undervalued compared to its last price as of April 24, 2025. Major research houses like DBS and OCBC maintain buy ratings, though their target prices have been revised downwards. CLCT currently trades at a price net asset value of 0.6 times for both FI25E and FI26E. However, the consistent downward revisions of target prices by major research houses suggest a more cautious near-term outlook. The reasons for OCBC's reduced fair value estimate, explicitly linked to the DPU estimate / and a higher cost of equity, reflect an uncertain macroeconomic backdrop and the potential risk of CNY devaluation. This suggests that while the long-term investment thesis for CLCT might hold, the short to medium term could see continued volatility and DPU pressure. Dividend sustainability. CLCT's current dividend yield is attractive, reported at around 8.0% to 8.25%. But, and this is a massive concern, the trailing 12-month payout ratio is deeply negative, cited as -632.48% or -53%. A negative payout ratio means the company is distributing more in dividends than it is generating in operating earnings. This is a significant warning sign for sustainability. It implies that current distributions are likely being funded by non-operating means, such as utilizing cash reserves, issuing new debt, or, crucially, proceeds from asset divestments like CapitaMall Shuangjing, CapitaMall Qibao, and the upcoming CapitaMall Yuhuaiting. The 16.2% DPU plunge in FI 2024 already signals underlying pressure. A dividend cut is a distinct possibility if profitability doesn't improve. Growth prospects. Growth is tied to continued positive retail sales momentum. Successful asset enhancement initiatives, AEIs, and positive rental reversions are key drivers. DPU accretive acquisitions and effective capital recycling through the new C-REIT are also expected to contribute. The long-term play is benefiting from China's pro-growth policies and exploring new economy assets like data centers. However, growth will likely be gradual and uneven, highly dependent on macroeconomic improvements and successful execution of complex strategies. Key risks: China's economic slowdown. Weak consumer confidence and deflationary pressures directly impact property performance and earnings. Foreign exchange, FX, volatility. A weaker RMB against the SGD has already negatively impacted DPU. Oversupply and negative rental reversions, especially acute in business parks and logistics. Dividend sustainability. The deeply negative payout ratio remains a major red flag. Geopolitical tensions. Ongoing US tariffs and trade tensions create an uncertain environment. Interest rate sensitivity. While 76% of debt is fixed, a 50 bps increase in SGD interest rates could still impact DPU. The combination of a high-risk dividend profile and significant macroeconomic and geopolitical headwinds creates a challenging investment environment. So, what's the verdict? The assessment from the sources indicates a complex investment proposition, given the prevailing macroeconomic uncertainties in China and the challenges to dividend sustainability. It presents a balanced view. While the current dividend yield is attractive, its sustainability is questionable without improved earnings. The strategic initiatives offer long-term potential, but the near-term headwinds in China's economy and real estate market necessitate a cautious approach. The analysis suggests that investors should closely monitor the progress of CLCT's strategic pivots and the broader economic recovery in China. For any investor, approaching with prudence, assessing risk tolerance, and considering a long-term investment horizon are crucial. If you're considering CLCT, here are the key factors you absolutely must monitor. Dividend sustainability. Watch CLCT's profitability and dividend payout ratio closely. A sustained improvement in operating earnings is crucial for dividend coverage. China's economic recovery. Track consumer confidence, retail sales, and government stimulus. These will directly influence CLCT's retail performance. Performance of new economy assets. Are business parks and logistics parks improving their occupancy and rental reversions? Recovery in these segments is vital for overall portfolio growth. S-REIT progress. How successful is the CLCR launch, and how is CLCT deploying the capital recycled from divestments for accretive investments? Foreign exchange fluctuations. Be aware of the RMB to SGD exchange rate impact on reported DPU. CLCT's strategy to increase RMB-denominated debt aims to mitigate this, but it remains a factor. CLCT is navigating a complex landscape. While it has strategic strengths, the immediate risks, particularly around dividend sustainability, are significant. Always do your own due diligence. If this video helped you understand CLCT better, give it a thumbs up, subscribe for more in-depth analyses, and let me know your thoughts in the comments below. Thanks for watching, and happy investing!